Welcome back. This is PSG. This week we're going over chapter 13 entitled Technical Analysis with Penny Stocks. It's going to be 5 key points that we're focusing on this week. It's going to be trusting technical indicators, knowing when a trading pattern is failing, profiting by spotting specific trading patterns, understanding when technical analysis does not work, using trading patterns to predict penny stock prices. All right. Before we dive in, I do want to remind you all I am not a financial advisor. Also, I did want to remind you all I am under the assumption that you all are doing your reading to where you can take the information you've read and gained in notes and information from the videos and apply what always works best for you. Technical analysis, also known as TA, is very important, but I do feel as though it can be dangerous, especially when you're starting out new if you don't really know what you're doing. So with the technical analysis, the book also points out within this type of trading pattern or style, you're not going to be paying attention to things on the fundamental operational side, like we may have discussed in previous chapters. You're not going to be looking at the management team, revenues, how much debt, percentages of employees that are turning over, things of that nature. So TA is definitely going to be more tailored towards volume, high price fluctuations, trends, things of that nature. So let's go ahead and move along and dive into some of these technical analysis. They point out that some different situations where technical analysis can be effective. It'd be effective if you're a short-term trader, not a long-term investor. Simply put, the reason being, with this type of approach with the technical analysis, most of these people are not holding these stocks overnight or over the weekend. So you're talking about a high amount of volume coming into a company, and that's really what attracts these type of day traders. It also points out that you want to eliminate all the work required for a fundamental analysis. You're not looking at the market share. You're not looking at the revenue, the profit margins, anything related to that nature. Within this approach, you're trying to squeeze as much gains out as fast as you can to be in and out and on to the next company. Also, you want to minimize your investment exposure. This goes back to why with this type of approach, day traders are typically in and out. They're not trying to risk a lot of dollars or risk holding over the weekend and coming back on a Monday where some things might happen over the weekend out of their control, and now they're automatically down on their on their initial investment. So their initial price that they bought in. Also, you need more clarity about good buy and sell opportunities. Studying patterns, trading volume, and price direction is extremely important if you want to be even decent at this type of approach. You do have to understand as well that sometimes this stuff does not work with penny stocks. Sometimes you'll see often within penny stocks, you're not getting that type of volume fluctuation to really feel like you can buy low and sell high within that same day. Also, you need to be mindful if you're just starting, your account might not even be able to have the potential ability to day trade at the time. So you may have to work your way up to $25,000 or whatever your brokerage rules are to allow you to day trade. So you need to know your rules, definitely. Charts and patterns. The book also points out that sometimes some may spend 40 to 60 hours a week studying different charts and patterns. You got to understand, as detailed as you are, that will be as successful as you will be. You have to continue to grow and learn different aspects of the market. And studying charts is a big part, especially if you're going to be trading off volume, not caring about whatever the company has going on, strictly trading off volume. So you need to know the differences and the risk that lies ahead if you are to do so. All right. Within these charts, you need to be aware as well within these patterns that there's different chart time frames you can look at. You can look at a daily chart, hourly chart, a 30-minute chart, 15, 10, 5. You're going to need to put in the work to study and read to find out which chart methods work best for you. Within looking at these charts as well, you need to be doing a good job trying to identify within these charts where you can see an upward, constant, or a downward trend. That may be a good indicator to go ahead and sell. Support levels are just as important as resistance levels. You need to be familiar with the terms and how they go hand in hand with looking at charts. Simply put, resistance is going to be the opposite concept to support levels. At that time, it could be almost like a wall where it feels like it's having a hard time trying to get over that hump, quote unquote, for the day. On the back side, support, that's going to be where it's showing almost your base, your bottom for the day, from your base, based on your ability to study the chart. Price dips and price spikes. You need to be able to look at those. You need to have your, also if you're, I have some videos up prior regarding how I use scans. Your breakout scanner, you can have that sensitively set up where you're getting certain alerts when certain amounts of shares are starting to move. So within the OTC, there are times where sometimes you might see an increasing amount of volume pour into a company. By having your alerts set up, you'll be able to spot those right away. If you don't have your alerts set up and you're not hawking this, trying to see different price movements on penny stocks, then you can't expect to be decent at this. The book does a good job showing some different charts. I do feel as though you need to spend time looking at these different trends and play them to the best of your ability. Momentum indicators is another part, as well as averages. Looking at the averages, the daily average. You can look at the volume historical as well. I use that as a good way to indicate how many shares have been pouring into the company lately. Typically, I'm trying to find a bottom within the company. So I might look at the last 6 months to see where it's been trading the last 3 months, the last month, and then the last 2 weeks and see how much volume to kind of have an indicator of, hey, this kind of looks like this is where the bottom is, that support level. Having your signals set up, your buy signals, your sell signals. Simply put, your buy signal is going to give you an idea of where you may want to buy, sell. Likewise, on the other side, ideas of where you want to sell, being able to see the strength within the chart. These are all indicators that are very important. The book does a good job this week getting into detail. I'm not going to go further into detail regarding those different trends. I'm expecting you to be able to do your reading and also add value to what you've learned. I hope this did help some of you all. Chapter 14 is going to be entitled 10 Rapid Result Tactics, and they're going to focus on 4 key points. They're going to be getting to know the product or service being sold, comparing the penny stock company to the competition, gauging where a company is in its life cycle, and adapting your portfolio to best capture stock market gains. Well, I hope this does help you all. As always, only apply what you see fit. This is PSG. Hope you all have a great day, and we'll see you next week for Chapter 14.